Welcome to Expert SEM Supply Chain Knowledge Sharing session. In this session, we will see something called quick ratio. It is an indicator of company's short-term liquidity position and measures company's ability to meet its short-term obligation with its most liquid assets. Since it indicates company's ability to instantly use its near cash assets, the assets which can be converted quickly to cash to pay down its current liability, it is also called as acid test ratio. An acid test is a slang term for a quick test designed to produce instant result. The quick ratio measures the dollar amount of liquid assets available against the dollar amount of current liabilities of the company. Liquid assets are those current assets that can quickly converted into cash with minimal impact on price received in the open market, while current liability or company's debts or obligations that are due to be paid to be the creditors within period of 1 year. A result of 1 is considered to be a normal quick ratio. It indicates that the company is fully equipped with exactly enough assets to be instantly liquidated to pay its current liability. A company that has a quick ratio of less than 1 may not be able to fully pay off its current liability in the short term, while the company having a quick ratio higher than 1 can instantly get rid of its current liabilities. For a quick ratio of 1.5 indicates company has $1.5 of liquid assets available to cover each dollar of its current liabilities. Thanks for watching. Bye.